Everybody, welcome. Thank you for joining us to the Financing Banking on Brooklyn panel. We have very respectable gentlemen who've been very active in lending in Brooklyn and beyond it for probably some decades. I'm going to let them introduce themselves. Let me just tell you who we have here with us. We have Mr. Lowell Dansker, Chairman and CEO of Intervest Bankshares Corporation. Thank you for joining us. Josh Zegan, Managing Principal and Co-Founder of Madison Realty Capital. Welcome, Josh. And Eugene Kennedy, Managing Director and Banking Group Head at Customers Bank. Hi, Gene. Thank you for joining us. And just quickly, before any lending, everybody knows that financing is a huge part of every transaction, including everything that we heard in the other panels. All these deals happening are usually not happening without loans, without commercial funding. Before we delve into a little bit more detail of what the market looks like and what lenders are looking to lend on and how they approach the deals that they're doing, why don't you take a few, just a short introduction of each one. Josh, why don't you go ahead?
Sure. Josh Zegan with Madison Realty Capital. We started the firm in 2005. We've done about $1.6 billion of debt and distressed debt deals. Typically special situations in the middle market between $5 and $50 million loan size. Time-sensitive transactions, construction loans, recapitalizations, and then in addition to that, we've also acquired about $700 million worth of real estate, all New York metro area, multifamily, mixed use, retail, and construction, Brooklyn, Manhattan, Staten Island, Queens.
Hi, my name is Lowell Dansker. I'm the chairman of Intervest, and I'm also the chief lender. By the color of my hair, you can tell that I'm the one that Efrat is referring to who has made loans in Brooklyn for decades. I've been in the business for 38 years. We're a nationally chartered bank. I make loans in about 19 different states. The concentration is here. I do a lot of what I call scratch and dent lending, which is properties coming out of foreclosure, bankruptcy, divorce, death, or some other mishap. I also do a tremendous number of triple net leased single tenant deals across the country. I've got my main office here in New York, and I've got 6 offices in the west coast of Florida.
I'm Gene Kennedy from Customers Bank. Our office is in Manhattan. The bank is about a $5 billion asset bank based out of just outside of Philadelphia. Opened the office here in New York about a year ago. We, out of New York, are focused on transactions up to $40 million. Greater New York area, metro area, Southern Connecticut, Northern New Jersey.
Thank you all. So at TerraCRG, the financing department, we've done deals with all 3 lenders. I know you went a little bit over what you are doing, but tell us in a little bit more detail, what type of loans are you after? What property types will you lend on? What are you looking to lend on? We'll get into more specific examples later, but now very quick round of, so we can establish it for the crowd of what you're looking to lend on.
So typically the deals that come to us have some sort of a situational component to it, whether it's has to close in 2 to 4 weeks, or so time is the essence situations, recapitalizations, restructuring opportunities, construction lending in the middle market where a borrower may have a great asset but may not have the best of construction background. But we're very basis driven in general. We're asset first, borrower second. And that's really how we look at things, because we know that if we had to own the real estate, we have the ability to, given that we're a vertically integrated company. We have our own property asset construction management, and we develop properties and own properties ourselves. So while that's not the goal, we've done, last year we did about $500 million of transactions, and a lot of them had a value add component to it where there was a lease up, there was the typical banks today, a lot of them are looking for stabilized assets, and perhaps credit quality wasn't what a bank wanted or liquidity wasn't what a bank wanted, but for us the asset is most important, and we understand the asset.
I also am an asset-focused lender. We did about $300 million worth of originations last year, and they'll range from 9-month bridge loans at a pricing a little bit different than my friend on the left, who we've been friends for many years. Also special situations where what I call they have hair on them. where they have to close very quickly, where there's a buy down of an existing mortgage with another lender, where the owner has gotten into trouble for some reason or another, and we look at the asset. In terms of the sizes, here in Brooklyn, the loans will range from $500,000 up to about $12 million. We do situations here in Brooklyn where people are buying properties that are partially vacant and need to be upgraded with new kitchens, new baths, new wiring, paint the public halls, clean them up, and re-rent them. And some of those loans literally last for 9 months. They're easy in, easy out, usually personally guaranteed, usually with some kind of deposit made in the bank to also give us what we'll call debt service coverage, even though there isn't any cash flow to cover it. And that product is something that we do day in and day out.
So I'm on a little more of the traditional bank, commercial banking side of things. Generally, we're dealing with stabilized properties, permanent lending, although we do a fair amount of bridge and a certain amount of construction as well, although it's typically not what we're sort of leading with. I guess our sweet spot is sort of 2 to 3 million loan size up to maybe 15 million or so. We have a sort of single point of contact model, and our credit folks are sort of in-house, in-market, side by side with the banking officers, loan officers, and generally lending against all different types of product type. Obviously, do a lot of multifamily in New York, and obviously a certain amount of commercial and industrial as well.
So I hope you had a chance. Thank you for the parameters. I hope you had a chance to look at to attend some of the other panels. We saw throughout the day, we had people talk about stabilized multifamily projects. We saw people talk about, I think they're talking about it right as we speak, about their development projects. Later on, we're going to have a retail panel. There are all sorts of deal types, property types, and as we all know, deals usually come down to the scenario. The needs of the financing come down to the scenario and to what the lender will put forth for the borrower. So I appreciate you telling us what you generally are lending to, as I asked you to. Now, I would like to know, I think people would like to know, what would be the most competitive scenario that you think what are you good at? I know you know what your institution is good at. Now, we want to know too. So what's the best, where are you going to win the business? And when do people want to come to you to get the deal?
So, typically it's a timing situations are the best for us. We're able to do a very comprehensive underwriting in a short period of time. But the reality is there's a lot of deals that, a vacant building, a building where someone may not have that much equity in, but or cash in, but has a great basis and bought the property historically in 2010, 2011, and have the ability to buy it a partner or, something where we can get in for some historically good basis. But, whether the sponsor has a ton of money in or not, that's not as important to us. Also, just construction loans where someone needs to finish a project that was started in the past, and we've been a large part of what we did 2011, 12, 13, and this year have been recapitalizations of projects that were 80% complete, 90% complete, where we had real visibility into the market. We had the ability to come in mid-construction, which a lot of lenders don't necessarily like, given they're not necessarily able to always figure out what happened in the past, ascertain cost to complete, and that's something that we feel very comfortable with. So an example of a deal like that was a deal we did in Flushing last year, where we recapitalized a $50 million, we made a $50 million loan, recapitalized a 150,000 square foot project in Flushing, where Bank of China the loan had matured, the mezz lender was trying to foreclose, and the borrower needed $5 million to finish and had contractor liens. And that was, sort of our sweet spot, where we were able to be in for $350 a foot when the market at the time was $600 a foot, but yet an asset-rich borrower who didn't have liquidity. So asset-rich, cash poor is our best, and that's sort of our sweet spot.
Thank you.
Well, as a bank, we need our borrowers to have some cash. Sometimes that does stand in the way of a deal, and then they go to my buddy here. But when we look at a deal, recently I did a deal for someone that other lenders, bridge lenders here in the city had looked at. I did it on a bank basis. It was a retail condominium unit in Manhattan, and the borrowers had 9 days to close. And we took it from start to finish, including loan committee approval and everything else we had to do, and we closed with them in 9 days. The deal was real simple. They had been with another lender. The other lender wanted a $500,000 account for TI. I was dealing with principals who had a lot of money. I didn't need the TI account. And the other lender was stubborn and insisted on being there at least a minimum of 1 year, and the guys only wanted to be able to pay me off in 6 months. So we structured the deal. We did it with them rather quickly. They were super pleased. I was pleased to have the asset. I came in at a very good basis. I've got confidence in the people that they'll get the job done. But for a bank to turn around a deal in 9 days is almost unheard of. To do that, sometimes we work for 24 hours, or we'll work over a weekend. Most lenders, most banks won't do that. Your bridge lenders will, your shadow banking lenders will. But it's just a question of hustle and understanding the value of the property and being able to work with people and trying to tailor the deal to what they need and still make the yield that we're comfortable with.
Thank you, Josh and Lowell. Jean, before you give your answer, so I just want to say it's really great that we have lenders for these situations. They're a little bit, I don't know what to call them, a little bit wilder, a little bit hairier, a little bit more of the story to tell to the lender. It's really great to have, but as we all know, when we go and try to get loans for deals that are more middle of the road, and those deals need financing too, there's always something. The conversation is not always so short. So Jean, when you give your answer, I want you to feel comfortable that you can finance deals that are maybe, I know you have the ability to listen to stories, and I know you have the ability to lend on them, but I want to hear also what do we have for that more middle of the road financing, and how much story would you listen to?
Yeah, no, we do get a lot of stories. You know, in theory, you know, most of our product is sort of a vanilla, traditional bank permanent lending product. However, you know, even in that sphere, there's almost no deal that comes across the desk that ever ends up being sort of vanilla start to finish. So, you know, our model is I think I mentioned before, sort of single point of contact model, relationship-based model, where, you know, ideally we're doing deals for folks that we're going to have relationships with for many years and do many deals with. So, you know, sometimes where we've been able to kind of break into the market where other banks, you know, so maybe it's sort of a traditional product, but maybe there's a little angle here or there that makes it sort of a little bit difficult for maybe a traditional bank to lend on or give them a little bit of discomfort. So, you know, in those kind of situations, we look for sponsorship to be strong and to say, you know, this is sort of a wedge into a relationship that we want to be in. So at the end of the day, it may get packaged up and sort of look like a traditional commercial banking financing. However, you know, it seems more and more, particularly lately, I'm not sure why it is, seem to be getting a lot more sort of out-of-the-box type of asks that maybe sort of start out as something seemingly traditional, but, you know, have some moves in them along the way, I guess I'd say.
So I'm actually going to skip to a question that I plan to ask a little bit later, because it has to do with everything that you just said. I think this question is actually going to be maybe a little bit harder for Lowell and Josh to answer, and a little bit easier for you, because I want to take one step further outside the box. Your deals are already pretty much outside the box. So we know that a lot of lending institutions, especially banks, but also probably everybody that their business plan is to lend money for commercial real estate, they really care about relationships. They really want to find the right borrowers. They'll do things for the right borrowers that they won't do for other borrowers. And we all know that the business requires character and conduct and execution power and risk management and challenge management and a lot of things that not necessarily everybody has. A lot of people that we've seen here today do have them, but you still sift through and choose your. I hear that a lot with in conversations with lenders for the right sponsorship. So I want to know what constitutes, and it's a little bit the ideal. So it doesn't mean that's the only sponsorship that they're going to do deals for. But what constitutes the right sponsorship for you that you're going to be willing to take as I said, another step outside the box for those guys or girls.
Do you want me to start?
Sure, go ahead.
Well, the sponsorship, unfortunately for us, sort of starts with, will this person pass, Patriot Act requirements and KYC and all that. Fortunately, there's a lot of scrutiny in the banking world today with that. But really, generally, as I said before, we're sort of relationship focused. So, the best relationships I have are with the folks that, particularly the folks that we went through, 2008, 2009 with, and kind of rode that wave with them. And, being able to point to a deal that comes across your desk today that maybe is slightly outside the box of what we would traditionally do, but we really like the sponsor, and we rode that wave with him or her back in 2008, 2009, and he or she did all the things we asked of them. That's probably the most important thing to point to, and frankly, sponsorship is sort of the first or second thing, first or second question we get asked. Well, who are these folks, and how do you know them? How long have you known them? I mean, it's literally goes in the first paragraph of the write-up. So it's critically important, and for us, typically we're not looking to do just one-off deal. We're looking to provide other banking services for those folks, both personally and commercially. So in addition to the lending side, we're also offering the other side of the balance sheet, cash management and deposits and all that. So, sometimes we even use that side of the balance sheet as an entrance into, getting into a lending relationship with somebody that maybe we've known for a long time, but maybe we've never been able to do business with. But, I think, to us, sponsorship is critically important.
So, Jean, if you have a borrower that you haven't had a lot of experience with, but you have ways to talk to other lending institutions that did have experience with them, does that qualify as getting to know them as
Yeah, I mean, it's
good enough
it's
introduction?
a small enough world, particularly here in New York. And I think what you've seen with the banking world, and particularly probably over the last 5 or 6 years, is you've had so much movement in bankers, and you've had a lot of banks come in and out of the market, and be in one part of the market and sort of step back, and another player jumps in. So you've had a lot of movement of people. So our group at Customers Bank, as I said before, the office in New York has only been here for a little bit over a year. But the reason I joined was because I knew a lot of these folks from being in deals with them in previous places, and so it's sort of the same dynamic at work. So there was somebody I saw out in the hall before who I used to work with at J.P. Morgan 10 years ago, and he had called me up on a name that he knew that I banked, and he couldn't remember if it was the good brother or the bad brother because he had a deal that came across with the same name. So there's definitely a lot of that, and that's critically important.
So you don't just go by the family name, you
That's
actually...
Right.
Okay. Lo,
The first thing that I look at is the real estate, because at the end of the day, if your sponsor was a wonderful guy and he had a lot of money and something happens to him, what you're left with as a lender is the real estate. So I do my real estate analysis, then I check to see who the borrower is and do the background checks that we need to do. We'll run just a Google search, and it's amazing what comes up on a Google search that the guy forgot to put on the questionnaire. It's staggering sometimes. How did you forget that you declared bankruptcy 6 times? So we go through that kind of thing, but the relationships are important. I've been doing this for 38 years at this point, and I've got situations where I'm dealing with the children of guys that I met with my father literally 38 years ago. I've got clients that have stayed with me a long time. I've got clients that have outgrown me because my bank is about $1.6 billion in size. We do have a lending limit of about $18 million on any given deal. And some of the guys that I worked with in the beginning have become extraordinarily wealthy. They've done very well. They still send me a bottle of liquor at Christmas time, but they don't come to borrow any money from me because I can't accommodate their needs. So I deal with a lot of first-time borrowers. I always have. I check them out as carefully as I can, and I want to know about the character. I want to know the guy's buying his first building, but what he's been doing till now. So we can check them out as carefully as we can, but again, my main focus is on those bricks, because at the end of the day, that's all I got. So hopefully we don't have any bad characters, and we weed them out.
Thank you, Lowell. Josh, before you answer, so you're the non-bank in the group and a private lender. I think there's a conception that you may care less about the borrower and more about the asset. I know for a fact that you're looking for relationships and you're looking to build pipelines with borrowers. So tell us a little bit, and Lowell, thanks for relating to us how you feel about first-time borrowers. We also know that not all lenders would consider a first-time borrower. Sometimes it's very difficult to get a loan when that's your first crack at commercial real estate. So why don't you clump the the answers to both questions in one, and just tell us, how do you feel about relationships? Would you do more for one borrower, less for the other? Would you consider a first-time borrower? How important it is for you?
In general, we look at things a lot like Lowell in the sense that we're, asset first, sort of borrower second. But that being said, there are a number of entrepreneurs that really know how to use the flexibility of our capital and turn the property, turn the money, find conventional financing post the execution of the business plan. And because of that, we've had a number of repeat borrowers over the years, and there's no question that those repeat borrowers that have executed on a business plan in the past are people that will want to do more with in the future, and therefore, there's definitely a relationship base there. There's a number of people that, for 10 years we've worked with, 5 to 10 times over that period of time. So that's important, finding the type of borrowers that know how to use our capital, know how to get in and out of deals, are, talented in executing on a business model. That's what we really look for.
If you all remember the first time you went out for a job, and the person on the other side of the desk said to you, but you have no experience, why should I hire you? It's like the dumbest thing somebody could say. You've got to get in someplace. So to hold it against somebody that they never borrowed before or never bought a building just doesn't make sense. Most people who go into this business have a relative in the business, whether it's a father or an uncle or somebody that brought them up in the real estate business. And the fact that they never bought a building before does not mean that they can't be successful. So we go with first-time buyers, and we've had a great success record with them.
So let me ask you, I wasn't really planning on asking this, but
Then don't.
I will. You've said yes to a lot of loans, you've said no to a lot of loans, to a lot of borrowers. What would be your advice to a first-time borrower, or maybe not very first time, but in the first few deals, when it's still difficult, when they still hear that response more than a welcome? What's the best?
I think a lot has to do with when I meet with people to see if they understand what they're buying, and if they have, as Josh used, a business plan. What's the schedule? What are they going to do? And then I have to make a judgment as to whether or not I think the person has the capacity and the ability to complete what he says he's going to do. We don't do any construction financing. So the closest I get to that is buildings that are partially vacant that someone is buying to renovate the bathrooms and the kitchens, et cetera. And I listen carefully to them about what their plan is, and then I make a personal judgment as to whether or not I think they can do it. Now, some people will come to me, and I will tell them that they have to open a bank account. You can do $100,000 worth of renovation work. You got to put the $100,000 in the bank. And I say, we have a gentleman's agreement that you'll only use that money for the hard and soft costs and the carry costs of this property. You're not going to go out and buy a Porsche. You're not going to do anything else with it. So when we see the checks coming through, we know it was for stuff done at the property. And yet there are other borrowers who I'll tell them, you got to put the money in the bank and you got to show me the bills, and then I'll let you take the money out of the bank. So a lot of it has to do with just plain simple character, the man or woman's knowledge of the project, and understanding of the intricacies of what they've got to do. I didn't start in this business as a lender. I started this business as a principal, buying and selling real estate and renovating it. And I did thousands of apartments and hundreds of miles of roof and 100 boilers and heating systems and you name it. Not everybody knows everything on the first day, but you can get a sense of comfort that they've called people, they found out things, and they learned in the process since the day they signed that contract and decided they were going in the real estate business.
So you're saying know your business plan, show that you know it. If you have character, show it.
Show it.
Okay. Josh, what would you say?
I would just say that one of the things, when we see deals go wrong, it's typically because someone didn't do their homework. They're buying and have no sense of historical valuation, don't have the proper infrastructure, don't have the proper people to execute a business plan. It's always, you can buy something really, really well, and then if it takes you 3 years to execute on the business plan, it all gets eaten up in soft cost, interest, and everything else. So where we've seen it go wrong is the wrong infrastructure, the wrong personnel, someone that's not detail-oriented, and that's where we see it go wrong.
And when he sees it goes wrong, that's where he makes his money. I hopefully finance somebody and it doesn't go wrong. A little different
I think
stage.
Josh is still saying he wants to see solidity.
Absolutely.
Right.
But the problem that he sees, if I can paraphrase, he sees someone else's problem that his client's coming in and taking over or rescuing, or he's going in and rescuing. I'm making
in
the
many
initial
cases,
loan.
yes.
So there's a little bit of difference there.
Fair enough. Gene?
Right. I
He
mean,
has no problems.
well, we have no upside. The best thing that happens is people actually pay us back. With first-time borrowers, I mean, I think it's the same mistakes you probably see in, a lot of other, business scenarios. But, probably the most common one is people just don't have an appreciation for how much things are really going to cost and how long it's really going to take. And I think we found with more junior borrowers or, first, second time around that, their projections are never as realistic. They're always overly optimistic in terms of what things are actually going to cost, or how much work and time goes into a zoning variance or something like that. That they think it's just a matter of sending someone downtown to for the afternoon. So I think that's the one thing I think we're always looking for is have these folks thought those kind of issues through. Do they have a backup plan? Is there some other direction they can take the project in? There's one other point I had a second ago. I guess it's always helpful too when you're talking about first-time borrower. Does the person have a background in the industry? So were they a broker? Were they a banker? Is there some reason why they have knowledge of the market, and do they really understand what the market is? And sometimes there are folks who do that. My background originally was on the C&I lending side and, doing non-real estate here in Brooklyn. And we had a lot of clients who, got into real estate rather, because the operating company they had, whether it was manufacturing sweaters or something like that, was kind of an industry that was no longer really necessary to be doing business here in Brooklyn. But the family had owned the plant for 40 years, 50 years, and turned it into condos. And so there were some projects over the years where we did for folks like that who were great business people, but maybe they hadn't really been involved in real estate before. And again, it kind of goes back to our the point about relationship and do the folks at the end of the day know the market that they're in.
How about, just to tell me if you agree or not, when people are a little newer, would you advise them not to ask for the world? If they just take a step back and ask for something a little bit more conservative, that everything they can get, would you be more open to, or it doesn't really matter? And
I love lending money, but I'm a lender who always tells people to take less debt. The less debt they have, the less chance they're going to run into a problem. So if there is something that's unforeseen that they did not think about, they're not struggling. So I always counsel them to bring in more equity, and everybody says, well, I don't want to share. And on your first few deals, maybe you should share. You learn the ropes with other people's money and not putting your skin on the line. So the less debt, the better. When the crunch came in 08, 09, and 10, the folks who hadn't leveraged their properties up to the eyeballs, who lost some tenants and their revenue dropped, they ate the same 3 meals, they went to Europe with their wives over the summer, and they did everything the same because they were not overloaded with debt. So that's my counseling.
okay, thank you. So I know this is a panel about banks. We haven't said a word about interest rates. I promise we will, but I'm going to leave it for a little bit later on. And before we go, I want to go also into some just deal examples. I'm going to give you an example of a deal that we're working on. I want to hear how you would look at it. But before that, just to cover a few ends. Secondary financing. Would you consider? I know that maybe it has to do with the question with what I just said, that borrowers are asking for things that are not so straightforward. A lot of people need that small little piece above the first mortgage that's going to be there. So 2 questions. A, how do you feel about it? How do you feel about it as a practice? how do you feel, would you consider allowing a second piece behind you, and would you consider being that subordinate loan?
No, no, no.
So you're saying cancel secondary financing from the market?
Bring in an equity partner.
Just don't do it. And you
Too
won't.
much debt can kill the deal. A perfectly good first mortgage can be killed by the fact that there's mezz or other debt behind it. Therefore, we just don't permit it.
True, but what if a lender makes a first mortgage and the first mortgage is a fairly low leverage? It has to do with the parameters of that lender, and
I do that. I do that all the time
with.
with my own loans. If I have the first and the client comes back and says, "Look, I renovated all 16 apartments. I've doubled the rent. I want to take out another $1 million." I'll give him $1 million second, coterminous with the first, at bank rates, not at a second mortgage lender's rate. And the reason why I'll do it is because it'll save him from having to pay the mortgage title insurance premiums again on the first $1 million that I loaned him 12 months ago.
So that sounds like
So I'll
yes.
use the format of a second, but together my first and second would equal what I would put on as a first.
Okay.
That's just to save him money.
Okay. Josh?
So, I mean, the way we look at things is a little bit different. My last dollar is really the most important thing to me. In some cases, subordinate financing or deep-pocketed subordinate financing is a good thing. Now, we typically would want, obviously to approve that, and a mezzanine loan versus a mortgage, because a mezzanine loan in a bankruptcy is not a creditor, it's a pledge of the membership interest, which is, very different than an actual mortgage. So when we look at things, we, case by case, if we have deep-pocketed people behind us and we can be in for a good basis, that's sort of the focus of our deal and how we determine secondary or no secondary financing.
Gene, would you have anything to do with secondary financing?
No. Not that we be doing ourselves. I shouldn't say that. Obviously, it's just not, our product. But, there are deals probably more on the non-real estate side than the real estate side where we're going to be dealing with mezz lenders and other folks. My background is historically a little bit more on the corporate finance and C&I world. And, that was very common in those scenarios where the lender's only willing to go up to 2 or 3 times funded debt to EBITDA, but you have mezz debt behind you, and then maybe you have equity behind you, or notes, or whatever it is. So on the real estate side, the one thing I would say there is, every once in a while we're asked to come into a deal where there's senior debt and mezz debt in place, and we're asked to take out the senior and sort of leave the mezz debt. And that really never seems to work. I think the deals where sometimes you have the mezz lender and the senior lender together on the front end, structuring the deal. I think that in certain instances will work for the right scenario if the senior's at a low enough LTV or whatever the reason is why you need a mezz lender in the first place. But those other scenarios where you're asked to kind of come in and replace someone when there's an existing structure, that piece never really seems to work very well.
Okay, now I want to talk again shortly about process. There could be a potential conversation that takes place that many times replicates itself throughout the industry, where people will go to lenders like Josh because they feel that the banks are taking they say that the process is sign up the term sheet, get the appraisal, get all the reports in, get the checklist, the due diligence checklist, throw it to the legal, we're done. Get approved in the middle, throw it to the legal, and done. But some people feel like the banks are going to take 8 months of their lives, and they have to balance out what do they prefer, the shorter, maybe higher interest rate, or the longer, more let's call it brain-damaging process of the bank. So what's the reality as far as your institution? How easy is your process? What's going on there? What is a borrower facing when they're getting a loan from you?
Our
From
typical
the fund side.
Sure. Typical process is, I would say, 2 to 4 weeks. The 4 weeks being more of a construction-oriented deal where there's definitely a need for an engineer or something like that. But we have a pretty flat organization. There's about 40 people in our company, and the decision is really our investment committee is myself and my co-founder, Brian Schatz. So that has given us definitely an advantage in being able to make quick decisions, and especially in areas where we understand the real estate really well, which, any of the 5 boroughs, northern New Jersey, we can make very quick decisions. When we go outside of New York, typically that takes a little bit longer because while we've been in many markets throughout the country, it just normally takes a little bit longer to understand the dynamics of the market.
I try to shoot for 30 days from the time that I issue an LOI and checks come in to close a deal. It's a little bit tough to do in a banking scenario. The federal government has reams of requirements for us, which sometimes I hate when a client says, no other bank asked for that. And then, of course, they produce the piece of paper, global cash flow, and it's got another bank's name on the top because they just did it for them a month before. So the easiest thing to say is, you're the worst, and you ask me for too many things. But the fact is that we move it through a process. I try to shoot for 30 days. I'm usually about 35 days. We will ask for funds up front for the inspection, for the appraisal, for the phase one. We will order it immediately because that is the thing that takes the longest. And then we work with our brokers, as I've worked with Efrat on deals, where we push back on the broker and say, here's the checklist, go to your client's office and drag this stuff out of this person and get it here so we can finish the underwriting. Because we must have a complete file before we close the deal. We don't want to be in a situation where we could be criticized by our regulators who come in on a regular basis because they don't like real estate. They don't understand real estate and they don't like it. So all I do is real estate lending. We have a $1.6 billion bank. I have no personal loans, no single-family home loans, no HELOCs, no automobile loans, no business loans, only real estate. So I want every file to be letter perfect so they come in, they do their job, and they leave, and I get to do my job.
Well, for that kind of thoroughness, it still doesn't sound like such a long, tormenting
I get
process.
deals all the time that come to me from other banks.
Right.
Where either the broker or the principal has come to me and said, I've been with XYZ Bank for 60 days. I've got to close in 19 days. I have no surety of closing. Will you take over the deal? I get them all the time. I get recommendations from other banks. I get people call me up and say, Mr. Smith over at such and such a bank told me to call you because he can't do it for 90 days, and I need it done in 33 days. So to me, that's the best endorsement in the world when I get that kind of a call, which comes from an officer of another bank, because we can do it.
Gene, what about your process, customers?
Yeah, I mean, we've tried to make that a point of emphasis and a point of differentiation. I think we've been getting beaten on deals where somebody else is coming in at 1/8 of a point, 1/4 of a point cheaper than we are. But we've really tried to make the process as seamless as possible. I mean, it was actually refreshing for me, having only been with the bank for a few months, knowing what I know from previous banks I've been at. Generally, through our model, the sort of single point of contact model, we have folks in market who, sit down the hall from me that, have signing authority up to, a dollar limit that probably captures 90% of what we do, or it may even be higher than that. So, it's folks that we know that are sitting there and, you can grab and bring into a conversation or put on a call. So, from the time that we have a completed package, and, I mean, we are still a bank, and, you're always sort of, I always feel like I'm apologizing when I'm giving the diligence list. People think they're issuing a bond or something like that, because there is a lot we ask for because of, all the compliance aspects we're subject to. But, generally we've been turning things around commitment-wise in a week and a half, which, I'm used to commitments taking 45 days or 60 days or whatever. So it's sort of refreshing, and that's one of the places where, I think our model does seem to work.
Well, thank you. And I will say this as a broker who places debt and usually has the opportunity to go to many lenders at the same time. The truth is a beautiful thing, and we really have the option to say how these lenders work. What happens sometimes, what happened at other times, and I can at least attest for these lenders that they're very close to the truth. and,
Just close?
Very, very, very.
Wait till she comes for the next deal.
Okay, so now I want to talk a little bit about Brooklyn. I know you guys know Brooklyn well. Lo, you've been lending in Brooklyn for 38 years, so since you've been, what, -4?
Something like that.
Yeah, and activity is on the rise, obviously, in this borough, and we've heard it all day. We've seen it for probably over 2 years, very, very intensely, and I want to know, how are you partaking in this, and has anything shifted in your outlook of this market recently? And recently could be, you can interpret recently as you wish. Just tell us what it is. And are there any things that deals that you'd be open to now that you haven't been open to in the past in Brooklyn?
I tend to work in markets that are changing because I don't make loans on the Upper East Side multifamily building that's stabilized and not my business. So I go from market to market, and I've been very active in the Brooklyn market. We've done a lot of work in Williamsburg. We've done a lot of work in Bushwick. I can tell you that I can come out of the L train, and I can walk down Berry Street or something, and I could just know the addresses of stuff that I loaned on before anybody loaned on it. And we did it as private lenders before I bought the bank and ran the bank. So I've been doing it for a long time. I watch this business as a cyclical business, which we all know. So there's a time to do and time not to do. But I'm game. I've made some development loans, not construction loans, but the land loans for some folks here in Brooklyn in the last year or two that I'm happy to do. I think there's still some room in that market, depending on how many dollars a foot they're paying for the property. And I do a lot of these, what I call small, 8-family, 10-family, semi-rehab jobs where someone's going in and cleaning them up and doing a job, and then they'll go out to the more traditional savings banks to get their long-term financing.
Josh?
We've been
Your Brooklyn?
Sure. We've been active in almost every part of Brooklyn for 10 years. And I think one of the biggest challenges right now is that some of the markets have increased so much over the last year to 2 years, especially in land, that it's, really thinking about historically where was this in 2010, 2011, 2012 sometimes doesn't even apply, because in a place like Williamsburg, today you have J. Crew that's coming. You have a Whole Foods that was, probably 30 to 50% more people there than were, 3, 4, 5 years ago. So, historical value is important, but in some markets they've changed so much that you can't really look at that. Certain things that we've looked at, we made an office-related loan on 29 Ryerson about a year ago, before the office market really started to pick up, and we thought it was a great basis given it was 220,000 square feet. We were going to be in for $100 a foot in the Navy Yard. Values in office rents have gone up so substantially, given that tech related companies have realized their personnel all live in Brooklyn and they want to be close to their personnel. So that's like a market that's changed so dramatically in the last year. You're seeing it in Dumbo, you're seeing it in Williamsburg, you're seeing it in Navy Yard, other areas, Gowanus. So those are things that, an area of the market that we've gotten involved in the last year that we weren't previously, but there's such a substantial business model there now that has changed in the last few years.
Jean, I know you live in Brooklyn and you've lived in a few neighborhoods. How about the lending side?
Yeah, I mean, we it's just amazing how much activity we see in Brooklyn. I can't say that we've specifically targeted it, but there's just so much activity going on in Brooklyn these days. I mean, it just kind of finds us. I mean, that's where so many deals are getting done. We've seen a lot in Queens too, but in Brooklyn, I got to Brooklyn. I got to Metro Tech probably 13 years ago. It was a much different world. Even I guess I've been living in Brooklyn for about 9 years, and it's changed pretty dramatically in that amount of time. We see players who historically have only been in Manhattan or only been outside the city coming into Brooklyn, and I think that's a good thing, generally speaking. Although we'll wait to see. I mean, there are a lot of deals that I think we're seeing in the market today that I'd be a little bit concerned about come refinance time and what happens with rates, which I guess you want us to talk about at some point. But but I think it's just been healthy for the borough, and we're seeing opportunities in all different pockets and really in all different product types too.
Okay, great. So let me tell you a little bit of a deal example we just started working on, and I want to know how you would look at it. Let me describe the deal first. It's an acquisition, 24 units in 3 adjacent 8-unit buildings. 10 of the 24 units are vacant, and the borrower is a good borrower, good net worth, good liquidity, but wants to get as much as he can get, and will go with a bank that will give the most aggressive proposal. There is a 60-day TOE, time is of the essence. We have to close in 60 days. And the 10 units that are vacant probably need some level of renovation. would you look at this deal? Would you consider it? Under what terms? You don't have to get into details, but how would you approach it? What would you, some kind of structure that you would have in mind? What LTV would you figure? Would you give money out of the construction as well? If you absolutely insist talking about rates, we're not going to stop you. If you don't, that's fine. So how would you go about it? Josh?
Sure. Well, first of all, a deal like that, obviously we'd think about it in an as-is and an as kind of stabilized value. And, given the vacancy and the tenancy, what we can do with that building, can we convert the unit mix? Was it undermanaged before? Were the rents under market? And, typically we would probably lend 80% of cost and 65% of completed value. And debt yield or yield on cost would be something that would be very important to us. So if our last dollar was in for a 7.5 cap, when I would be able to buy that at a 4.5 cap today, that would be a healthy spread. So that if I had to liquidate the asset, I could liquidate it at that 4.5 cap once stabilized, or 5 cap once stabilized.
My difference is that I would probably go in with less money, being a bank, just to keep from a regulatory point of view. So I'd probably come in somewhere between 50 and 65% of his purchase price. Because it doesn't cash flow, we'd have to put up a reserve, which stays with the life of the loan, or at least until he meets a 1.2 debt service coverage. I would provide for funding some of the renovation costs after he renovates it and pays for it. So once it's completed, give him back some of that renovation money, maybe 75 cents on the dollar. Term could be a year, term could be 2 years, point in, a point out, a 4% rate, 30-year amortization, and a signature on it.
Gene, would you look at this deal, or would you wait for it to take it out of these two?
I think it would depend on sponsorship and relationship. I mean, it's not something that we would typically lead with. However, I think if we're going to structure it, and if it's for someone we know and love, it would probably sound a lot like what Lowell just described. Lower loan to cost, lower loan to value, however you want to look at it. Definitely a recourse deal. I mean, it just for us, it would sort of start with recourse. Some sort of reserve or side collateral or something, or at least something to get through stabilization to get to the right debt service coverage. And, we could structure something like that on a short-term interest-only basis, but, converting to an amortizing basis after 12 months or whatever the work was going to take.
Okay, so you could do the takeout too. I think you guys would prefer somebody else came in and took the loan out, right? Okay, now, so that was my deal. I want to hear if you can share something that you are working on, have completed in the past few months. Just give us a little bit of a taste, to the less general. What have you guys been doing? A deal example. Gene, why don't you start? You had the.
You'd sort of prepped us for this question. I can't remember which deal we picked, but one I'll talk about, and I'm not sure if this is one you wanted me not to talk about, but I'll talk about it anyway because I was talking with your client out there, and he has kind of a similar situation. But we're working on something right now where it's sort of a customer we know and love, and his niche is in owning and renting out single-family townhouse properties in Manhattan. And the challenge there is, you're really never getting on a rental basis what the building is really worth. So you tend to be lending at a very low loan-to-value, which is great, although it's a very stressed debt service coverage. And now he's in the process of acquiring another property, and wants us to sort of roll in a couple of existing properties into that, and come up with a mix a collateral package that we could get comfortable with. And if you throw enough of these together, does it start looking like a multifamily analysis? Maybe, but he doesn't own that many of them. So, I think I threw that one out there because it's sometimes applicable at something like that. For a first-time lender, smaller lender on a property that's substantially less than what a townhouse in the Upper East Side costs these days. So this deal, if we can find a way to make it work, is going to be a much larger one. But it's kind of that low loan to value, but more stress debt service coverage test that's sort of the art than the science piece, making sure we're comfortable with that piece.
Okay, thanks. Lo?
Before I came here today, I sent out an LOI on a piece in Brooklyn where my client, who I did his first deal for him probably 3 years ago, he's now on deal number 7. Each deal was raw. He went in, he did his job, did what he was supposed to do, took me out with permanent financing from another institution, and he keeps rolling on to the next deals. He's buying an 8-unit building that's going to be delivered vacant. I think his price is about $965. I'm giving him $735,000 on a 2-year deal with a point in and 30-year amortization. He's putting up a debt service reserve that I need. He's going to open a bank account in the bank with about $130,000, which is what he figures are his hard, soft, and carry costs over the next 12 months. If he prepays me in the first year, he owes me a point. If he prepays me any time in the second year, he gives me 30 days notice and he owes me 0 other than my principal balance and interest to date. He personally signs for it. He's capable. I hope I get the deal. For me, it's an absolute home run. And for him, I believe once he completes it, where it is and the type of property it is and the skill set this young man has, he's got himself a home run and he'll be with me with deal number 8.
Thank you.
Deal we recently closed actually was St. John's Hospital in Queens, in the Elmhurst neighborhood of Queens, across from major shopping thoroughfare. And basically it was a deal that had to close by year end, a 3-week close. The acquisition was about $55 million. It was a 280,000 square foot former hospital that had gone through a BSA variance when the former owner bought it out of bankruptcy. They got it planned and approved for about 150 apartments, retail, community facility, and it really was about a time-sensitive deal. We closed with a $38 million loan, which was, it was about $150 a foot. They're now building rentals at the property, but land pretty much trades there for around $150 a foot. So it was a very good basis, and that was the number one priority in terms of that deal. We are providing also construction financing, which is happening now.
Very good. Okay, so I want to talk very shortly about interest rates. And all I want to ask about interest rates is not what are your interest rates, but rather there's been, in 2010, everybody was convinced that in 2011 rates were going to go up in the market, and with them rates for loans for real estate are going to go up. That didn't happen last year, or in 2013, everybody was sure that it's going to happen in 2014, and I think this year we're all talking about 2015. And every time there's this feeling and then there's this conviction in the market, some lenders react, some lenders withhold reaction until the time comes. So what I want to know is, it's hanging there as a notion. How do you account for it when you look at deals? Does it change? Do you take it into account when you choose which deals to go for? Are you accounting for it in your underwriting of deals? What is your relation to that notion of interest rates going up at some point?
So I mean, from our perspective, how we know rates are going to go up at some point. We don't know how much. Is it 50 basis points, 100, 150 basis points? Is it a year? Is it 3 years? What we do know is when we underwrite deals, we just want to make sure there's enough margin that on a refinancing, or if I ultimately have to take ownership, there's enough cushion for us to get out of the deal. So I do think that, given that a lot of banks are lending at very, very low rates, and making deals work based on those low rates, there's risk to the system in terms of refinancing, and that's something we think about. And obviously that may create another distressed opportunity in 3, 4, or 5 years.
I set rates on an individual basis, on a deal-by-deal basis, as the deal comes into me. And I will quote and hold that quote for 60 days based upon certain parameters of the Federal Home Loan Bank rates. We all know that rates will go up. We do long-term loans. And I had a broker on the phone this morning, and he's asked me for a 10-year deal on a retail piece down in Miami. And I'm more than happy to make a 10-year loan on it. I'm satisfied with the collateral, satisfied with the borrower. He's got a lot of cash in the deal. And I told the fellow that my fixed rate for 10 years on a 25-year ammo was 520. And his remark to me was, but the 10-year fell down today. And I was trying to hold back my, not my temper, but whatever, my commentary. And I said to him, but I'm going to be holding this for 10 years. Oh. It's like it dawned on him. Oh. So we have to watch interest rate risk. It's something that is very important because most banks have inexpensive deposits today. They all vary in terms of their cost, but those deposits will become more expensive during the life of the loan. And unless you are swapping out your deals or unless you're taking in fixed deposits against certain time buckets, you have interest rate risk exposure. And the only way you can compensate for it is you need amortization. You need to price it right coming out of the box. So at least for a good part of the loan, you've got a positive spread. So it's a deal-by-deal, day-by-day basis.
Thank you. Gene, do you incorporate that into your choice of deals and underwriting methods?
Yeah, I mean, it's a big concern, I would say, that, you know, that probably all of us have in the banking community right now. But, you know, it's a big point of emphasis at our institution. You know, going much beyond 5 years fixed at this point, I think, is a challenge. I think it's, you know, a big concern about, you know, what rates are going to look like 5 years out, 7 years out, and what that's going to do to prices. You know, for our underwriting, you know, we're stress testing at 200 basis points and 400 basis points, and you know, some of that is regulatory driven, but you know, 400 basis points from where we are now, you know, out 5-7 years isn't crazy, and it's hard to find deals that work at that stress. You know, it's sometimes hard to find deals that work at 200 basis points. So it's definitely a concern. You know, it will come. I mean, if you look at the underlying indices today versus a year ago, there's a difference. But you see pricing in the marketplace that doesn't really reflect that. So lenders have been, you know, eating some of their spread, and there's been compression. So, you know, that's something I think everyone's aware of and very sensitive to right now.
Okay. Well, thank you very much. I want to open it for questions. We don't have a long time, but if there's any questions in crowd, yes.
Would somebody ever come to you who could get financing at large banks, or only, I think maybe in your case they would, but you know what I'm saying? In other words, would you compete with a large bank on somebody who's, you know, asset rich?
I normally won't compete on rate because I'm just going to get killed. Whether or not.
So the question was to these lenders, will they be able to compete in loan terms with people, with borrowers who can approach larger banks?
You know, I'm not going to commit rate suicide. And in my bank, it's a publicly held bank. I'm a major shareholder. So, you know, I eat what I kill every day. And I don't want the exposure. But where I can beat out that large bank is that there's not 16 layers of committees to go through where the deal that started out on one level, by the time it gets back to your principal, it's a different deal because each committee decided to change it along the way. I'm the chairman of my loan committee. I've got outside directors who understand what I do, why I do it, and how I do it. And if I explain it...
What are your interest rates? But rather, there's been, in 2010, everybody was convinced that in 2011 rates were going to go up in the market, and with them, rates for loans for real estate are going to go up. That didn't happen last year or in 2013. Everybody was sure that it's going to happen in 2014. And I think this year we're all talking about 2015. And every time there's this feeling and then there's this conviction in the market, some lenders react, some lenders withhold reaction until the time comes. So what I want to know is, it's hanging there as a notion. How do you account for it when you look at deals? Does it change? Do you take it into account when you choose which deals to go for? Are you accounting for it in your underwriting of deals? What is your relation to that notion of interest rates going up at some point?
Once you saw Dr. Einerson's.
So I mean, from our perspective, you know, how we know rates are going to go up at some point. We don't know how much. Is it 50 basis points, 100, 150 basis points? Is it a year? Is it 3 years? What we do know is when we underwrite deals, we just want to make sure there's enough margin that on a refinancing, or if I ultimately have to take ownership, there's enough cushion for us to get out of the deal.
Sometimes we're able to beat, the big, the 800-pound gorilla banks on structure rate, things like that. But a lot of times the sort of super regionals really focus, if it's a product like multifamily and that's their thing, they're very aggressive there. And yeah, we compete with them all the time.
Two quick questions. How do you feel about environmental issues, so manageable environmental issues? And secondly, do you ever lend against loans?
Against?
Loans, if we're out making a loan, using loan as collateral, so you're two levels.
Environmental issues are very important, again, from a regulatory.
Let me just repeat the question. So the question was, how do you feel about environmental issues, and would you lend against loans versus properties?
So we like to look at what the environmental issue is. If I make a land loan, and it's got a little E designation here in the city, I tie up my borrower and say, you're not going to put a shovel in the ground. I'm doing your acquisition loan, and you're not even going to walk on the property while I'm there. Once you get your construction financing, God bless you, you do what you want. So the environmental is quite important. I don't personally lend against mortgage debt. My buddy here does. It's just not a market that we play in.
So as Lowell said, with environmental, as long as it's quantifiable, there's an action plan, a remedial action plan in place, we have no problem with it. When there's a complete unknown, obviously, it's getting certainty that there. But on the other side, loan-on-loan financing or note financing, we do a lot of it. We did a lot of it in 10, 11, 12, especially when other people were buying debt. We were financing note buyers. We were a buyer ourselves, but we had all kinds of structures where we'd lend against a note. We'd give 95% and take some participation in the upside. We did all kinds of things and continue to do that. And, last year, at the end of the year, there was a deal that had to close. It was 2 multifamily, big buildings in the Bronx, loan in default, had to close in 7 days. And we gave a group 95% of the capital with upside. It ultimately paid off in March, but there was a huge premium because we were able to do that deal.
From the environmental side, I don't think there's anything we probably look at differently. If it's something you can sort of put a box around, then it's something we'll consider. But, the harder it is to put the box around it, the more difficult it's going to be. We typically don't lend against notes. We do lend to finance companies, business development companies, things like that, but not I think what you might have been thinking about when you asked the question.
Thank you. Other questions? Yes.
Could each of you say something about what you require in the area of personal guarantees? Maybe vis-a-vis the examples you gave. Well, I get the feeling you get everything signed all the time.
No, I don't get everything signed all the time. If the building doesn't cash flow, I really don't want to sit across from a boardroom table with a regulator who's probably my kid's age, who's going to tell me that I don't know what I'm doing and I should have had a personal guarantee. So in those cases, I know when to get it and when not to get it. I do triple net lease Walgreens and CVS's across the country. They're non-recourse. They're credit deals. I'll do a Burger King. I just did one up, I think, in Tonawanda, New York, but that's got a personal guarantee on it. It's a small franchisee. I don't think he's got more than 30 or 40 stores. So my owner bought it. It was a 1031 exchange. He's probably in there 50% cash, but I don't want any aggravation. And I don't want to be in a situation where if his tenant goes out on him, I don't want to be chasing him. It's real simple. Sign for it, and that's it. There's a deal I'm working on right now where I've told the broker I want a signature. And the gentleman bought the piece of property for about $9.5 million. I think he should have paid about $7.5 million, but it was a 1033 exchange, and he was on the last day after 3 years to close on a piece of property. Otherwise, he owed the government, millions of bucks. So he bought it for $9.5 million. I think the price should have been $7.5 million. I'm giving him $5 million, and it's got rollover risk in it. It's a retail piece, and I'm insisting on a PG. And the guy says, but my guy doesn't want to do it. And I said, wait a minute, your guy's got $4.5 million in this. What's he worried about? The net result is that hopefully when I get back to my office, I'll have the call from the broker to tell me to issue the LOI, and I'll close the deal with the gentleman. But I've got 6 retail stores. 4 of them roll in 3 years. I want the protection. I don't want to lose sleep at night. So it's a deal-by-deal basis for the personal guarantees. And sometimes it's 50%, sometimes it's a burn-off. It depends on each deal.
Jean, do you always ask for recourse? You have non-recourse?
We have non-recourse. You know, I think if you looked at our credit policy, it says recourse preferred, which is, you know, means whatever you want to take it to mean. But it's on a deal-by-deal basis, and it's full recourse on a lot of deals, and it's, you know, it's a no recourse on other deals. And a lot of times there's a stabilization guarantee or guarantee of debt service where, you know, we're okay with the asset. We know we could sell it based upon the equity that's in there and get out of it. But, you know, that's not really the way we're looking to lend. We're looking to lend on cash flow. So if we have rolling leases or, you know, risk that way, we're going to look for the principals to stand behind it and step in and get it released if it calls for it.
You know, most people say, I don't want to sign recourse. And you say, I say, why? Why don't you? Because the next time I go for a loan, the next bank's going to ask for it because it'll be on my statement. I mean, it's ludicrous. You want the loan, I'll do it, but I'll do it with recourse. Otherwise, take it someplace else. That's the way we have to be.
Josh, are you loans recourse?
Ours really case by case. Some are recourse, some are non-recourse. It's sort of deal by deal. A lot of construction-related deals do have recourse, but there have been cases where we do non-recourse and price that in. And even when we do a non-recourse loan, you really have to assume that you may have to act on the recourse, and therefore we get a lot of the file regardless.
Okay, I think we're out of time. I want to thank you all. You've been great. Thank you very much for attending.
Thank you.
You.